No nation believes its currency will fail. No government admits its guarantees might crumble. Yet time after time, reality delivers a different verdict. Across continents and centuries, from ancient empires to modern states, citizens have discovered their life savings reduced to nothing, their income stripped of meaning, and their security destroyed by institutions they considered unshakable. Financial catastrophe isn't exceptional. It's ordinary. The crucial question isn't if monetary systems break down. It's what shields you when breakdown arrives. Believing in eternal stability represents the deadliest economic error you can make. We check our accounts, observe our national money, and treat them as foundations. Yet currency isn't foundation. It's confidence, and confidence can disappear in hours. This makes historical study both harsh and invaluable. Each financial disaster creates a record of insights, recurring themes, and signals about what genuinely preserves value and what dissolves into nothing. Pay close attention and you'll notice the people who endured these calamities weren't those with the deepest faith. They were the skeptics who questioned early. Consider Byzantium, remembered as Rome's eastern continuation that persisted a millennium beyond the Western Empire's demise. Anchoring its commerce was the gold solidus, a coin so dependable that traders throughout Europe, the Middle East, and Asia trusted it completely. For generations, it functioned as the medieval world's nearest equivalent to an international reserve currency. But here's what longtime followers will recognize. You'd expect they would have absorbed the earlier Roman catastrophe with the silver denarius when leaders progressively weakened it until it became essentially tin with silver coating. That story has been covered previously. Yet somehow, centuries afterward, the Byzantines repeated the identical error with gold. They started reducing its fineness, diluting it further, blending in inferior metals. Initially, the changes went undetected. Then confidence fractured. The coin that had stabilized Mediterranean commerce became another political fabrication. This dilution demolished its trustworthiness, and, consequently, the Byzantine economy forfeited the security it had previously maintained. What endured? Not paper commitments. Not official pronouncements. Traders who had discreetly accumulated actual gold or property beyond imperial control maintained wealth while others watched their money vanish. That's the initial eternal principle. Authorities cannot withstand the urge to weaken their currency. When they yield, genuine value migrates to assets they cannot replicate. Yet not every breakdown originates from rulers manipulating coinage. Sometimes it arrives from upheavals that appear without warning. During the mid-1300s, Europe faced its most catastrophic pandemic, the Black Death. From 1347 through 1351, possibly half of Europe's population perished. Urban centers emptied, settlements disappeared, commercial pathways collapsed. Still, the economic narrative of the plague exceeds simple destruction. Because when half the workforce vanishes, labor gains extraordinary worth. Those who remained could command substantially higher compensation. Food and property, previously limited, became relatively plentiful measured against population. Households with available resources, silver, merchandise, or simply capacity to work, suddenly possessed bargaining power they'd never imagined. Property that previously demanded fortunes could be purchased for fractions. Dwellings sat vacant, farmland lay untended, and survivors entered a buyer's advantage. If this resonates with recent experience, it should. Throughout the COVID crisis, we witnessed a contemporary parallel. Distribution networks disrupted, authorities issuing trillions to prevent systemic seizure, and a surge of disparity as those holding liquid assets acquired holdings, while paycheck-dependent workers fell further behind. Across America, property values skyrocketed, equity markets rebounded almost immediately, while millions of regular citizens struggled covering basic housing costs. The parallel is unmistakable. Pandemics reallocate prosperity. They invariably do. Black Death survivors exploited scarcity for upward mobility. COVID survivors holding liquidity captured real estate, equities, and enterprises that others couldn't maintain. The principle isn't reassuring, yet it's accurate. Emergencies benefit those maintaining reserves and penalize those lacking them. While pandemics demonstrate how rapidly disruptions can transform economies, the banking failure in Renaissance Florence reveals something equally critical. Organizations appearing invincible can tumble like falling blocks. During the 1340s, Florence dominated European finance, hosting influential banking dynasties like the Bardi and Peruzzi. These establishments had extended massive loans to monarchs. most catastrophically to England's Edward III, who failed to repay enormous debts during his conflicts with France. When Edward ceased payment, the banks imploded. Account holders were devastated. Commerce halted. Florence, previously prosperous and dominant, descended into chaos. Average citizens who had relied on the city's formidable banking empires learned that magnitude wasn't security, and standing wasn't safeguarding. What did observers comprehend? That invincibility is a deception as ancient as finance. Organizations operate for profit, not to ensure your continuation. When they crumble, they'll consume your resources with them. This principle recurs every generation, from the Florentine crisis to Lehman Brothers during 2008 to Lebanese banks restricting accounts during 2019. Survival belongs to those recognizing that institutional commitments remain valid only until they fail. The American Civil War is commemorated for its conflicts, its governance, and slavery's termination. Yet beneath the warfare and declarations existed a ruthless financial struggle that most contemporary Americans scarcely comprehend. Both Union and Confederacy discovered that warfare at such magnitude demanded monetary creation. Northward, the government distributed greenbacks, paper currency unsupported by gold, but by United States commitment itself. Initially, the approach appeared daring and nationalistic. Yet, as greenbacks flooded circulation, their purchasing power declined. Price increases undermined their worth and confidence wavered. Southward, circumstances deteriorated further. The Confederacy, frantic for resources, manufactured graybacks in overwhelming volumes. By war's conclusion, Confederate price inflation reached nearly incomprehensible heights, costs rising thousands of percentage points, compensation purchasing virtually nothing. Military paychecks became valueless before soldiers could utilize them. Households transported containers of notes that scarcely bought single bread loaves. By 1865, Confederate currency wasn't merely weakened, it was extinct. What retained importance during that breakdown wasn't paper commitments, but concrete possessions. Property, provisions, gold, anything tangible, preserved worth while currency became a devastating mockery. For typical Southerners, this proved catastrophic. Accumulated lifetime resources disappeared into nothingness. For opportunists accessing material goods, the conflict presented chances to capture holdings and prosperity at bargain rates. It's a principle Americans seldom encounter, yet should permanently remember. Your nation has already experienced currency annihilation. When it occurred, protection originated not from trusting paper in your possession, but from holding value the system couldn't devalue through expansion. France additionally provides a severe examination of how upheavals can obliterate money faster than warfare. During the 1790s, as revolutionaries overthrew the monarchy and confiscated religious properties, they introduced new paper currency, the assignats. Supported theoretically by confiscated property values, these notes supposedly would stabilize commerce. Instead, authorities printed them recklessly. Each fresh emission weakened the previous. Costs escalated upward, compensation failed matching pace, and quickly the assignat became meaningless. Agricultural producers refused selling provisions for paper, requiring goods or silver alternatively. Throughout Paris, bread disturbances re-emerged and revolution consumed itself. Winners during this breakdown weren't those possessing patriotic paper. They were those controlling provisions, gold, or property, items authorities couldn't manufacture. For typical Parisians, comprehension arrived belatedly. Commitments, however admirable, hold only the value others acknowledge. When confidence shatters, your resources don't merely diminish, they evaporate. Advance 200 years and the principle resurfaces across Asia. During 1997, what started as speculative pressure on Thailand's baht expanded into regional catastrophe. Thailand had borrowed extensively in dollars, confident its currency peg would persist. Yet when it shattered, foreign currency obligations became impossible immediately. Capital fled. Currencies throughout Southeast Asia, Indonesia, Malaysia, South Korea collapsed sequentially. Economies contracted, joblessness surged, governments requested International Monetary Fund intervention. Those suffering greatest weren't the international hedge funds initiating the panic. It was regular citizens whose resources lost worth, whose housing debts doubled in expense, whose employment disappeared. Still, the pattern remained painfully recognizable. Those controlling dollars or international assets survived better than those trusting domestic currency. Countries reliant on foreign obligations faced imposed austerity, while Wall Street organizations departed with discounted purchases on Asian holdings. What appeared as regional breakdown was actually global wealth redistribution. The principle reflects every collapse from Byzantium through Argentina. Obligations in foreign currency constitute a fatal trap. When turbulence strikes, the creditor doesn't suffer, the borrower does. By this point, the picture should crystallize. Whether revolutionary France, Civil War America, or contemporary Asia, identical themes recur. Paper currency fails. Obligations enslave nations and households. Survivors are never those most trusting in systems, but those recognizing fragility before fracture. History's most unsettling aspect is that breakdown isn't merely ancient or remote, it's occurring presently. In Lebanon between 2019 and 2021, banks enacted something still seeming inconceivable to most developed world residents. They locked their entrances. Citizens awakened finding deposits frozen, withdrawal limits imposed, and currency collapsing. The Lebanese pound forfeited over 90% of worth. Lifelong accumulations became trivial change. Individuals queued outside banks, pleading for accessing personal funds, only receiving notification it had vanished. This didn't affect only small depositors. Middle-income households, pensioners, physicians, and professionals, anyone trusting the framework, were eliminated. The principle was severe and transparent. Your bank money isn't a secured vault. It represents a loan you've extended to an organization that can determine during crisis against repaying you. Those surviving best were those who hadn't, either distributing internationally, controlling tangible assets like gold or real estate, or maintaining currency outside banking systems. Everyone else remained trapped. If this seems distant, it shouldn't. During 2008, Americans observed homes seized and retirement accounts decimated while crisis-causing banks received bailouts. During 2020, throughout the pandemic, trillions were manufactured to maintain operational systems. A rescue that inflated asset valuations for wealthy participants while leaving typical compensation stagnant. During 2023, regional American banks collapsed nearly instantly when depositors lost confidence, reminding everyone that invincibility safety represents a fantasy we prefer believing until the entrance slams closed. So how do you shield yourself when everything disintegrates? History demonstrates there's no singular solution. In Byzantium, it was gold. Following the Black Death, it was liquidity for purchasing abandoned property. In Florence, it was refusing to trust invincible bankers. In the Confederacy, it was tangible goods. In France, it was provisions and real estate. In Asia, it was preventing obligations in foreign currency. In Lebanon, it was exiting banks before they secured their doors. The patterns shift, yet the theme remains consistent. Survival originates not from unquestioning faith in paper or organizations, but from recognizing what maintains genuine value when fabrications disintegrate. Here's the contradiction that should alert you. Breakdown represents both catastrophe and possibility. For the unprepared, it means destruction. Yet for those maintaining resilience, liquidity, or assets incapable of being manufactured artificially, it becomes the moment for acquiring prosperity at drastically reduced cost. Following the Black Death, laborers became property owners because property exceeded available farmers. Following 2008, those controlling cash purchased homes while millions faced foreclosure. History reveals that protection isn't purely defensive. It's additionally about positioning yourself for capturing what others, under duress, must relinquish. Yet prosperity isn't exclusively about possessions. It's equally about capabilities. Historical survivors weren't merely those controlling gold or real estate. They were those creating value when others couldn't. The baker still providing bread. The artisan still producing tools. The farmer still feeding communities. The trader still transporting goods across boundaries. These were individuals who didn't merely survive breakdowns. They ascended through them. During every emergency, currency loses significance, yet production never does. Populations still require nourishment, construction, exchange, existence. Those meeting these requirements are never impoverished long. That's the deeper protection, not blind institutional faith. Not hoping governments or banks will rescue you. Rather, the combination of tangible assets, genuine capabilities, and recognizing that fabrications invariably collapse. Every emergency represents a transfer. From the masses who trusted toward the minority who prepared. From paper commitments toward concrete worth. From passive savers toward active creators. History has demonstrated this pattern repeatedly. So the question isn't whether everything disintegrates. It invariably does. The question is whether you'll be among the masses holding commitments or among the few holding something tangible. History doesn't duplicate, yet if you disregard it, it will devastate you equally. If this provided fresh perspective, hit subscribe. History contains the solutions. I'll reveal where to discover them.